More on what's been going on with the euro. Let's bring in Stephen Pearson at Bank of America Merrill Lynch. Stephen, thanks for your time this morning.
Morning.
Obviously, one of the concerns not only has been the decline we've seen for the euro, but how quickly we've seen it weaken against other currencies. Were you caught off guard by the decline?
Yes, I certainly think the speed of the decline has been something of a surprise. We were certainly looking for a much weaker euro over the course of this year. Our year-end forecast is 128, has been for some time, but the speed at which the story has unfolded has surprised many market participants. I think it's a story around what happens when liquidity recedes and some of the underlying problems outside of the US come to the surface. I think that's what's driving this move, and it doesn't look to be over yet.
What about what comes next? Obviously, some say you need drastic budget cuts to stem the slide in the euro. What exactly are you looking for, and how does that affect your outlook for the performance of the currency?
Yeah, I'm not sure that drastic budget cuts will stem the euro's slide. I think drastic budget cuts, if they are pushed through by the peripheral members of the Eurozone, that will buy time. But the underlying issue that the Eurozone faces is that there's a great big gulf in competitiveness between the periphery and the core. Unit labour costs in Portugal, Greece and Spain are up around 35% relative to Germany since the EMU began, and that's created huge external imbalances which the euro covers up, but now we're starting to see markets focus on those, and it's how that is reconciled over the long term that really is the underlying vulnerability for the euro.
Steve, we saw the euro strengthen a little bit overnight. I mean, after weeks and weeks of pressure, and it seemed to be in reaction to the ECB President Jean-Claude Trichet making some comments saying essentially trying to reassure the region. Can government, can the ECB do anything to give a little more support to the euro long term?
I'm not sure this is an issue for monetary policy, and so the ECB's ability to solve or ameliorate the situation is limited. Certainly the ECB can maintain a loose standard of collateral for its open market operations, but beyond that, I think the ball's very much in the court of finance ministers, not central bank governors.
Stephen, we heard some comments from the finance minister of France saying that the weaker euro could actually be a positive for European economies. What is your view on that, and how might that affect the kind of response we see out of Europe?
Well, I tend to agree. I think if you came down from Mars and looked at the constellation of exchange rates that we currently have, you'd conclude that European currencies should be much lower against Asian currencies, and to the degree that that is now materialising partly as a consequence of these moves, then it should be welcomed. So, yes, I think it's an open secret that many finance ministers in Europe wanted a weaker euro, and now they're getting it. So your game theorists can have a lot of fun with that.
Stephen, quick question here. Our currency reporter Sarah Eisen pointing out that sterling is getting crushed right now. We know obviously the UK is not in the EU, but are there concerns about the UK system as well?
There are concerns. I think they're less well-founded. The sovereign debt of the UK is qualitatively different from the sovereign debt of EMU members because there is an option to monetise in the UK, which has been exercised. I think the problems that the pound is currently facing over the very near term really relate to the likelihood that the quarterly inflation report this week will probably print to the dovish side, given that GDP growth has fallen well short of the bank's very optimistic expectations, and so we'd expect euro sterling to continue to squeeze higher over the balance of this week and next.
All right, Stephen Pearson joining us with the latest on the euro weakness. Stephen, thanks for that.